The fuss has been going on a long time, and it's a secret body of people that meet. That even when I was in Congress and a ranking member on the banking committee, I was never permitted to go and know what exactly they talk about or how they establish monetary policy.
Tonight, we're going somewhere few dare to go, a place that controls our money, shapes our economy, and maybe controls a lot more than we realize. I'm here to introduce you to one of the most complex but effective institutions in the United States. Welcome to the Federal Reserve. Not quite government, not quite private, but totally powerful. So let's start with one fun fact that's not so fun. It's a private institution. The Federal Reserve isn't exactly part of the government, even though it controls the money supply for the whole country. No congressional control, no president calling the shots. Just private interest with power over every dollar we hold. Total power over the economy and no need to ask permission. There's a lot going on around the Fed, but keep in mind that the whole is really just the sum of the parts. Basically, the Federal Reserve is made up of three parts: the Board of Governors, the 12 reserve banks, and the Federal Open Market Committee, or FOMC. The complex design of these three parts is actually tied to how the Fed was created in the first place. To understand this structure better, let's first step back about 100 years. It all started back in 1910 at a quiet little retreat on Jekyll Island. Seven of the most powerful bankers and politicians in America took a secret train ride. No one else knew. They met, crafted a plan, and poof, the Federal Reserve was born. So private, even the waiters didn't know who they were serving. Funny, right? Seven bankers meet in the dark on a remote island and create a system that now controls our economy. What could possibly go wrong? You've probably heard of the bank failures that occurred during the late 1800s and early 1900s. Back then, the failure of one bank often had a domino effect in which customers of other banks rushed to withdraw funds from their own banks. These banking panics wreaked havoc even on financially sound banks and sometimes paved the way to serious, widespread economic recessions. When Congress wrote the Federal Reserve Act in 1913, one objective of the Fed was to help banks acquire emergency cash reserves to meet such panic withdrawals so that the shortage of funds at one bank didn't disrupt the entire banking system. Fast forward to today, the Fed doesn't print the money. That's the Treasury's job. But they control the supply. They can add money to the system by lowering interest rates or slow it down by raising them. They're like the ultimate puppet masters, and every time they pull the strings, the economy jumps. And here's the kicker. They can do it whenever they feel like it. No voting, no approval. If they want to drop rates and flood the system with cash, they do it. If they want to slam the brakes, they do that too. And for most of us, it just feels like prices going up or down without knowing why. The Board of Governors, which is a U.S. government agency, has 7 members, called governors, who are appointed by the U.S. President and confirmed by the U.S. Senate. One thing the governors do is write regulations to make commercial banks financially sound, which supposedly help make the nation economically strong. It's the governor's jobs, along with economists and support staff, to study trends in the economy and to help forecast the country's future economic direction. The governors also oversee the 12 reserve banks. One responsibility of the governors is participating on the Federal Open Market Committee, or FOMC. In all, there are 12 districts in the Federal Reserve, and each is served by a regional reserve bank. Reserve banks have 3 main responsibilities: providing financial services, contributing to monetary policy, and supervising commercial banks. Why is a reserve bank often called the banker's bank? This floor is busy around the clock. Every day, banks deposit billions of dollars at the Fed in cash, checks, wire transfers, or some other form of electronic payment for many of the same reasons we consumers use a bank. Computers transfer money electronically from one bank to another. Companies offer these services as well, but the Fed is a primary player in the business. Besides serving commercial banks, reserve banks also serve as banks for the U.S. government. They maintain accounts for the U.S. Treasury, process government checks, and assists the Treasury in issuing and redeeming securities. A third entity, the Federal Open Market Committee, brings together the expertise of the first two in setting the nation's monetary policy. Now, the FOMC, let's take a peek inside. It's the Fed's chief body for monetary policymaking. Here, the 7 governors from the Board of Governors meet with the presidents of the 12 reserve banks about 8 times a year to discuss matters. At the FOMC meetings, members together set a target range for its policy interest rate called the federal funds rate, which is the interest rate on overnight loans between banks. This rate influences other interest rates, like those for mortgage loans, and greatly affects the direction of the economy. To ensure the federal funds rate stays within the FOMC's target range, the Fed has monetary policy tools, such as the interest rate it pays to banks on their reserve balances, that can be used to steer the federal funds rate into the FOMC's target range. Each FOMC meeting ends with a vote on actions that will affect key interest rates, which then influence consumers and businesses' spending and investment decisions. As you might guess, the Fed conducts monetary policy. This isn't easy to explain, but let me start by telling you what the economists do. Economists at the reserve banks are supposed experts on different aspects of our national economy. Despite their varying perspectives, most economists agree, though, that the economy performs well when inflation is low and stable. As a result, low inflation is a long-term goal of the Fed. Now let's talk inflation, the sneaky little tax that no one talks about. Inflation is when your money loses value, and the Federal Reserve manages it by manipulating how much money is out there. Every time they decide to add more money, your existing dollars are worth a little less. Prices go up, but your money, it just can't keep up. And you feel it in the grocery store, at the gas pump, everywhere. And then there's debt. Lots and lots of debt. The Fed buys up U.S. government bonds, creating money that the government spends. Every dollar they create to fund our debt adds to that clock ticking away, higher and higher. Now they say they're just helping out, funding critical services, all that, but in the end, we're all paying it back with interest. The Fed gets paid back, and the debt keeps growing. It's almost like we're all trapped in this endless cycle of debt. So why don't we hear more about all this? The Fed operates mostly in the dark, with just a few meetings each year open to the public. They say it's to protect the economy from overreactions, panic, chaos, but maybe, just maybe, it's because too many questions could be inconvenient. If people understood that their money could be reshaped, devalued, or inflated by a small group of unelected officials, well, it might raise some eyebrows. It's like magic, only dark magic, and it affects everyone. And here's something else most people don't know. The US dollar is the world's reserve currency, meaning the Fed's decisions don't just affect us, they affect everyone. Every country that trades in dollars, every bank with US holdings, they all move to the Fed's beat. In other words, when the Fed sneezes, the world catches a cold. One decision here has ripple effects everywhere, yet no one outside these walls has a say. Seems like quite the responsibility for a private entity. So let's sum it up. We've got a private institution with the power to shape not just our economy, but the world's, without needing anyone's permission. They create money, control inflation, and buy up our debt, all in the name of stability. But in the end, it's the Fed calling the shots, and the rest of us, we're along for the ride. Stay curious, because every dollar has a story, and sometimes the people writing that story are the ones you least expect.
Gimmick that, that is a gimmick that is designed to help their special friends.